everybody's been targeting that 7,000 level, and it is massive overhead supply, not only in the options market, but it is massive overhead supply in year-end price targets and just, where hedge funds have set up for a year-end Santa Claus rally, etc. That 7,000 level is probably not going to be breached if we do rally. And therefore, when you look at a chart like this, and you look up at 7,000, you say, all right, well, that's my year-end target to play for. That's only 2% higher from here. So you have to start thinking about your risk reward is like, how do you, if you're positioning into year end, how do you position for a 2% rally into year end while being wary that you could go down 5% again very quickly. And so your risk reward has to look like that. And we've talked about, I'm just going to go to a little bit of a trade update here.
Okay.
So we talked about this trade, I think. When did we do this? A couple of weeks ago. So this is a way when I see a big spike in volatility, and you're looking for a capitulation and a bounce, that spike in vol in the options market lasts for a couple of days, right? I mean, it's coming down, but it's still high, right? When you're going from 28 VIX, you're going to be your first stop's going to be 22, your next stop's going to be 19. So when that's happening, you still don't really want to go, get too far over your skis and buying a bunch of really expensive calls, because they're still expensive from all that volatility. So we talked about this trade, which was, an iron butterfly, or you could do, it's basically trying to position for a move higher with as little premium risk as possible, and slightly short options, short volatility, short overall premium. And so this is the trade we looked at a couple of weeks ago. And it's basically, you can think of it as a 700 SPY price target, risking a very little amount of money to really have a outsized profits if the SPY is up around 700 into year end. And that's this trade we talked about, and it's doing great. It's up like 21%.